Hey y'all.
Hey
Hey,
yo. Hey, hello, mother. How are you doing?
fantabulous. How are you? I can't deal with this glare from these glasses. Oh, but I need them to read. So,
Another day. I'm grateful I didn't get that gene. Um, hey y'all, welcome back to the next episode of the Real Life Podcast for all things real estate and life insurance, hosted by my mother, Shanita Johnson, for all things real estate, and myself, Ariane Johnson, for all things life insurance. This week, we are going to be giving you some things you need to know about budgeting and saving, and then also how to use those budgeting and saving tips and a couple other tips for your retirement. So, Mother, would you like to start us off with some saving and budgeting tips?
so approach budgeting and saving, as you know, from the perspective of a holistic approach, right? Um, Especially when I'm talking to people who want to buy a home. Uh, because what I've learned is most people have never, ever set up a budget. And that's another thing that scares people off is the word itself, budget. So, okay, wait, let me take these glasses off because that glare is getting to me. um, so instead of saying budget, because I know many people do not like the word budget, I'm going to use a spending plan. And I like to use spending plan because, as many of you may know, may or may not know, I am an Army veteran. And so, if you know anything about the military, everything that we do is based on assignments. You have a mission. So, I come from that perspective, right? So when we're talking about money, I like to say you have a spending plan, right? And the spending plan helps you to put your money on assignment. There's a very popular person that talks to people about money. And I like this phrase that he says all the time, um, that, some people have more money. They don't have any money left at the end of their month. They have more month than money, right? But I like to say that if you don't put your money on assignment, if you don't give it a mission, you will always wonder where it went. Because if you don't tell it where to go, it'll be all over the place, right? It will be in Walmart, it'll be in Target, it'll be a Chick-fil-A, it'll be on Amazon,
It's
it'll
been
be a
many a
Smart.
time many a time I've checked a bank statement and like, dang, I thought I had 32 more dollars in this. Where did that 30? Oh yeah, I did get lunch for those past 2 days.
So you
Definitely.
have to put your money has to be on an assignment. You have to give your money a mission. So that's essentially what a spending plan is. And it's so simple to make a spending plan, right? I say it's simple, but it may not be easy, especially if you've never actually looked at your finances, looked at your bank statement, looked at um, your pay stub to see exactly what it is that you're spending money on. So that would be my first step, right? To creating a spending plan. Let's take let's take that first 30 days, right? Look at your bank statement, and I'm sure everybody has an app to their bank statement. So you can look at your app, your bank statement on your line, your banking app. Look at the last 30 days and see without judgment where you have been spending money. And that will tell you, right, what your habit is and where you can make adjustments. Don't just look at it, right? I want you to get something like this right here. Hold on. Hold on, hold on. Let me tell you. This is what you need to do. Get you one of these right here. See that? Get you one of
A
these.
piece of paper. What
Hold
is
with
this?
with
The
lines.
the
You need
1800s?
you need something with lines. So when you're looking at your bank statement, right? Look at your bank statement. Write down everything. So if you see on Monday you went to Chick-fil-A, Tuesday when you went to Chick-fil-A, Thursday you went to Chick-fil-A, Friday you went to Chick-fil-A and Starbucks. Write that down. Right. Also write down what you spent on paying bills. Also what you spent on your subscriptions, Netflix, Hulu, Spotify, Apple Music, all of the things. Get this paper and write it down. Because sometimes when we put stuff on this good device right here, it's not real because we can't, like, we're not physically touching it. We just see it with our eyes. But there's something about putting pen to paper that makes it real. There's a brain hand. I don't know the term for it. I don't know what it's called. The psychologist on the may know, but I don't know. But there's a connection that your brain makes when you physically do something with your hands. And so um write it down. Write down every single thing that you see. But look at the last month, as I said. Write down
Oh,
every single thing that you see.
you
Right.
just said something that
Okay.
I've been thinking about, the being able to see it
Yeah.
and not just writing it down, or of course writing it down. I don't know if all banks do this, but I've been seeing it more often. I have two different bank accounts, with two different, not two different bank accounts, two different banks that I use. And on both of those banks, and I think my husband also has a different one, and I think his does too. Um, they now have spending, uh, what's the
Track
word?
it. A
Tracker.
tracker. Yeah.
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 So you can use that to help you write it out because it
Mhm.
categorizes it.
Yeah.
It categorizes it by food and dining, groceries, bills.
Mhm.
So that'll help you if because I know sometimes just looking at a statement can get overwhelming. And if you're
Mhm.
like me, that does get overwhelming. But some check to see if your bank has a spending tracker so that it can help you list those out so that you can transform it from bank to paper because it categorizes it a little bit easier.
Yeah, it does, but I specifically want people to know to write down the actual amount from each place. So,
Yeah,
yeah,
it tells you all of that, but
yeah.
it just helps.
And and what I have seen with that, so you do bring up a good point. Yes, I will say most banks do have that. It may be called a spending tracker, it may be called a savings goal or something like that, but it will categorize your transactions based on the category. What I have seen though is sometimes it miscategorizes things. I know for my business bank account, it when I pay my property owners, when I send them their distributions, every month, it has it as one of my clients. I have no idea why it shows up this way, but hers shows up as entertainment. It's not entertainment. I don't understand why it does that, but so just be mindful of that. But yes, you do bring up a good point. So once you look at your statement, look at your transactions for the past 30 days, and we always want to look at 30 days because in a 30-day cycle you can see patterns. You also can see how you get paid or whatever. So once you have everything that you spent money on in the past 30 days on paper, because we're going to write it on paper, then the next thing I want you to do is write down on a separate sheet of paper all of your bills, right? All of your bills. So things that while you're looking at this spending plan, some of your bills are going to be on there, but some may not. But you write down all of your bills, right? So your rent, your mortgage, your car note, your insurance, all of the things, right? All of that down. And then on the last thing I want you to do on another clean sheet of paper is to write down your income. So whether that be your income from your job, if you're a W-2 employee, if you're a 1099, if you do some things on the side, Uber, DoorDash, any of those things, write down all of the income that you bring in every single month, right? So you have three sheets of paper, one with what you spent over the last 30 days. The second one is all of your bills, and the last sheet is all of your income. So what are we doing with these things? First, with everything that you spent, I want you to look at it. Look at it, and you're going to be shocked. You're going to be surprised because when you add up all of those numbers, especially with the dining out, I think that's the most surprising to people. That's in my experience, that's been the most surprising. People don't realize how much they spend on dining out. When you get that number, you add up all of the things that you spent money on and look at it. Don't judge yourself because this is a judgment-free zone. We're here to become aware of our habits, right? So look at it and see, okay, I spend $400 a month on dining out and I I don't have any savings. Well, that's an indicator that you could probably reduce spending every month so you can have some money saved, right? So once you take all that, your bills every month and your income, and you know where your money is going, you take your income and then your bills. Do some math. Take uh your bills every month, subtract it from your income, and see what number you have left. Whatever that number is, if it's a negative number, you know you have work to do. If it's a positive number, you still have work to do. If it's an even number, you definitely have work to do, right? Because if it's even, that means you're spending all of the money that you're bringing in. And if you're spending every single thing that you're bringing in, then you got to make some adjustments if you want to save for something like a house or a car or life insurance. If you're
Or
spending
emergencies.
and emergencies, if you're spending, if the number is negative, you got two options. You can either reduce your spending or make some more income, right? And the last place, if it's a positive number, meaning your bills and all of the things you spend money on, you still have money left over. You still have some work to do because maybe you can save more. Maybe you can invest more. Maybe you can, what we're going to talk about next, invest in life insurance or different policies for that. But you definitely want to sit down, look at your numbers. You have to know your numbers. When you go to buy a house, the lender is going to ask those questions. They're going to ask those questions, and you want to be prepared. You don't want to go in and say, well, I think I spend this much, or I think I have this amount of money. You want to be prepared to take that first step, take that next step, so that you can get the absolute best interest rate that you can, and you can get the house that you want within your budget, right? Within your financial picture.
Yeah,
So
because every penny counts. They check every penny. We bought our house last year, and the amount of paperwork and bank statements and pay stubs and all these things that they combed through. And I don't know if this is the standard in Tennessee. I'm not sure, but here you have to go through a first time home ownership course or class before you have to buy. And even when we went through that, they also went through our budget and our spending, and we had to go through a lot of back and forth because there were like discrepancies, and we could explain them. It just wasn't. We just didn't have everything fully in place as it should have been. So definitely making sure you know where your money is going and where your money is coming from and where it's sitting, and
absolutely.
it definitely
Yes.
will
So
hold you up if you.
yes. So that is a requirement. That is a requirement for first-time home buyers. A first-time home buyer is someone who has not owned real estate in the last 36 months, right? So yes, as a first-time home buyer, you are required to take a class. And yes, they do go over budgeting and spending and saving with you because that's part of, because not only do banks want to help you buy a home, give you the money to buy a home, they want you to keep that home because guess what? Banks are not in the real estate business. They're not in the business of owning real estate. They're in the business of money, giving money, giving money, and receiving money and a good interest that we pay on on the money that we borrow. So a spending plan is absolutely critical before you can do anything. Like we have to understand our money. We have to know where our money is going because if we don't, we will stay in a perpetual cycle of not having enough, not being able to save, not being able to live the lives that are fully our birthright. So please, 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 please get a spending plan. Get a spending plan. I gave you the 3 steps. Number one, we want to do an analysis. We want to do an analysis of what we're spending. That's the first step. Analysis is we take our bank statement past 30 days, write down everything we're spending, look at it without judgment, categorize everything from bills to eating out to self-care to home, things that you buy at home to laundry detergent, things like that, groceries, categorize those things. So now you know where you stand. Second thing I want you to do is write down all of your bills, the things you absolutely have to pay every single month so somebody won't turn it off or come and pick it up. Because if you don't pay your car note, baby, they're going to come pick it up. If you don't pay your electricity bill, baby, they're going to turn it off. So write down all of those things. If you don't play Netflix, they will cut it off after one day, right? So anyway, stay focused. So that's the second thing you're going to do. And the last thing you're going to do is write down your income, all of the places where you receive money from every single month. Write that down. Take your bills, take your income, do a little subtraction and see where you are. And then you go back to that 30-day view of what you're spending on and see how you can make adjustments. Now, if you can't remember any of that, what I just said, if that seems like it's too overwhelming for you, I will include the actual worksheet of the spending plan where you can just find the category that it fits in and you can just put it in there. And that'll make it easier for you if you don't want to do this. But you still got to write, because you got to write down the things, right? You still have to write it down. So we're here to help you. I'm here to help you because I want to see everyone take control of their finances. Because your money is not the boss of you. You are the boss of your money. Remember that. You're the boss of your money. Don't let your money boss you around. You are the master. The money is the slave. And if you confuse it, if you ever invert that, you're going to have some challenges. That's all I'm going to say. What questions you got about spending plans and budgeting? Ari.
Well, I think you answered all of the good points. We will link that down for the worksheet. We'll link it down in the description box so you can have easy access to that. I don't think I have any questions. I do want to, oh, not a question, but a point that we had made off camera, about putting your money somewhere you can't easily access it.
Yes. Thank you for reminding me about that. Yes. So when it comes to once you've done, and this glare is going to bother me. Once you have done all of your analysis and you realize, hey, I've been saving $25, I can actually save $125. So 2 things to help you save money where you don't even think about it. The first thing I want you to do is open an account, a bank account that is not connected to the account where your money comes in, where your income comes in. Let it be an online bank only, or a bank that is not convenient for you to get to. Why are we doing that? We're doing that because if your money is easily accessible, if you can easily get to it, you're going to spend it. So what I have done, I have a credit union here in Memphis. That's where my savings is. And I don't have an ATM card, debit card, or anything for that account. So when my income comes in every month, it automatically transfers to that account. I can't touch it. If I do want to get that money, guess what I got to do? Between the hours of, I think the bank is open 8:30 to 4 or something like that. But guess what? There's not a location that's close to my house. So I have to take some extra steps if I ever want to get that money, right? And so to make saving easy and inconvenient for you to get to it, not inconvenient for you to do, but inconvenient for you to get to the money. Put it somewhere where you don't have easy access to it, and automate your savings so you don't have to think about it. Because if you get in the habit of, when I get paid, I'm gonna put this money over there. If you have to think about it, you're gonna forget it. Set it and forget it. That way there's no problems, right? You just put it over there and leave it alone. And one more thing about saving when it comes to buying a home, it's not the amount that you save, it's the consistency of you saving. So whether if you can comfortably save $50 a month, save $50 a month, because it is so much better to consistently save $50 a month in a savings account that you don't touch than to sporadically put money in that account. So we're in December now. So if, let's say, I put $200 in that savings account in December, and then income tax time, let's say February, March, I put $400 in that account. And then I don't put any more money in that account until September. I put $50 in the account. And then next December, I put a $25 in the account. That's not consistent. And when you're in the process of purchasing a home, one of the things that lenders look at is your consistency. Are you disciplined with your money? Are you disciplined in saving? Are you disciplined in paying your bills on time? That discipline matters. So it is so much better to save whatever you can comfortably save every single month. Even if it's $50, even if it's $20, if you can save $20 every single month and not touch it, that looks so much better than saving money just haphazardly or sporadically and every other month or twice a year. It's so much better to do it consistently. And there was something else I wanted to say, but I can't remember right now because the thought left me because I was talking. So yeah, but make saving automated so you're not thinking about it. And yeah, make it somewhere where you can't get to the account easily. So,
Yeah, I'm gonna piggyback off what you said about automation. There
mhm.
are some apps out there that are connected to your to your card. So and every time you spend money, it takes that roundup amount and sets that aside for you. I've saved several $100s doing that. One of the app that I used to use is called Acorn. So let's say if the purchase was 16.20, it takes that 80 cent and sets it aside and it builds up and you can it also doubles as an investment account so you can invest that money as well. But you can just use it as a saving. And then the second thing was with cash. I used to work at Starbucks and we got cash tips every week. So for any servers or delivery drivers or if anywhere that you get tips or you come into contact with cash, you can do the same thing with cash. I used to set mine inside of a bag, inside of a box that was behind something. It was packed away, so it wasn't easy for me to get to. And I ended up saving about $600 in 3 months, I think it was, about roughly 3 months. And that $600 helped so much because it helped me move. So the same works with, oh, the audio's messing up again. Um, the same works with cash, being able to put it somewhere in a dark container that you can't see inside of and put it aside. So yes, now we have some savings techniques and options. We have to plan for our future because that's what the saving is for. Saving is for later, for the future and what's to come. Um, there are a couple different options for you. Now, she mentioned having a savings account. Not your regular savings accounts though, because typical savings accounts are, I think yours was zero,
0.025.
and that is so upsetting because that is
On the, let's say
barely
you
12
have,
cent a year.
right. So you have $1,100 in an account and the interest is 0.025%. That's 11 cent a month. 11 whole cent on $1,000.
Whoa, don't spend it all in one place. So what we're going to do instead, if you would like for our savings accounts, we are going to look for high yield savings accounts. The highest that I have seen up to date, and this is December 2025, the highest I've seen is 4.3 or 4.4%. I know a lot of people, if you're on YouTube a lot, you've seen a lot of people advertise SoFi. That one has a 4.3% APY. So look for high yield savings accounts. The higher, the better. That way we're not only saving 11 cent off of $1,100. That's one option for your savings accounts. The other options, if you're going to go through a bank, they allow the purchase of CDs, which are certificate of deposits. And these are, and the quickest explanation is for it, just for the sake of time, you buy it for a certain amount of money. Let's say it's $100, because I was actually looking at some not too long ago, and they were about $100. They take that money, the bank takes that money and holds it for a set period and returns it back to you with interest after that period. And you're not allowed to touch it within that period without, what's the word I'm looking for? Penalty. That's what I was looking for. But that's essentially a CD. Now, the another option that is specifically for retirement, you have multiple kinds of retirement accounts. Most people know about things like your 401k, your 457s, your 403bs, all of the numbers and letters as far as retirement accounts, and also IRAs. Now, most of these you get through your employer, and I highly recommend going to your plan administrator with whoever your employer is so that you know exactly what the plan is as far as how much is going in there, any of the interest rates, where the money is going, all of the rules and that go into how you're able to withdraw that money, when you're able to withdraw it, if you're able to roll over that money into another account. I will link it in the description, but there is an on the IRS website, there's a list of everything that you can look for, and your plan administrator is legally obligated to make sure you have that information. So make sure you go and do that so you know what is a part of your retirement plan, whatever retirement plan that you have. Make sure you have that information. But like I said, most of those are with your employer. Outside of your employer, you can still get things like an IRA or a Roth IRA. Now, what's the difference between a regular IRA and a Roth IRA? A traditional IRA and a Roth IRA? There are two main differences that I'll talk about. One, a traditional IRA, is funded with pre-taxed money. So the money goes in, but it is not taxed yet. And you do not get taxed. It's a tax deferred account. You do not get taxed on that money until you begin to withdraw that money when it's time for you to retire. So all those taxes and things will build up. And you also cannot touch that money until you are 59 and a half. Otherwise, you will receive a 10% tax penalty, and we don't want to do that. Yes, and then also you are mandated to start withdrawing that money. I think it's at 72. I think it's 72 or 73. Otherwise, you will get taxed some more for not touching your money. It's called a required minimum distribution, or an RMD. A Roth IRA, on the other hand, that is funded with after-tax or post-tax money, meaning that money is already taxed before you even put it into the account. So when it's time for your distributions, you will not be taxed on that money, which we love. It is tax-free income. However, you still have to wait until you are 59 and a half to touch that money. Another big thing when it comes to IRAs is that there are contribution. A contribution is money that you put in. Distribution is money you take out. There are maximum contribution limits when it comes to your IRAs. They are based on your income and your marriage filing status. But for the most part, $7,000 a year. You cannot put any more than $7,000 a year. Also, if you make a certain, like I said, income status, say for instance, I have to go back and check for the specific number because it does change every single year. But let's say, for example, if the limit is $164,000 a year, I can't remember specifically, but let's just say, if that's how much you make, and it's a little bit more if you're married, if that's how much you make a year, then the IRS is like, okay, great, you've made your money. You can no longer put money into this account. And that's for all of your IRAs. It doesn't matter. They all have max contribution limits. But that's the gist. If you go on my Instagram page, I do go into all of the different kinds of 401ks and all of the IRAs. And the next thing I'm going to tell you about, all the information is there. The next retirement option is something called an annuity. Now, an annuity is it's a savings retirement account specifically for retirement. Its sole purpose is for retirement. It's a retirement plan. And an annuity is a contract that basically says you're going to pay all this money, and in return, you will receive you will receive a distribution or an income. Now, there are options for it to be a lifetime income, so you can't outlive that money. But there are also options for to get a certain amount of money for a certain amount of period, a fixed period for a fixed amount of money. So those are your two main options. There are different kinds of annuities. You have fixed annuities, set amount of money, set payments, set distribution payments, and a set interest rate. There's a minimum interest and a current interest. You'll never get anything less than the minimum. And then you have a fixed indexed annuity. We'll have to go into a different conversation about how indexing works. But basically, indexing is the investment is tied to the performance of the stock market. So if it does well, you do well. But if it doesn't do well, you do not suffer any consequences. You don't lose any money. And the last one is a variable annuity, and that money is directly invested into the stock market. So if it goes up 20%, then you get 20%. But if it goes down 20%, you lose 20%. So make sure you're considering that one. And
Before you continue, I want to ask, because you said there's with the not the variable annuity, the one you said just before it.
and fixed index annuity.
Okay, fixed indexed annuity. Okay, you said there's a minimum and a max. What determines the minimum and the max?
For the index annuity or just a regular fixed, because there's a fixed annuity, then there's a fixed index annuity.
Both.
So the regular fixed annuity, there's a minimum interest and a current interest. And that's dependent on the insurance company that you're getting your annuity from. I don't know that changes from insurance company to insurance, and it changes from time, but there's always a minimum set amount.
So it's not based on the market. Is that
No,
what you're saying?
if you're talking about as far as performance as growth or whatever, and when it comes to indexed annuity, oh, I think I know what you're talking about. Okay, when it comes to index annuity, the way that the growth works, oh, I understand. When the way that the growth works when it comes to indexing, there is a floor and there's a cap or a performance rate depending on what market you're investing in or that it's tied to. So the floor is when it comes to the growth of your money, the floor is 0%. It can never go below 0%, meaning if the stock market is down 15%, you can't go below 0%. So you will not lose any money. The cap is the set amount that you can make. So if the stock market goes up 15% and your cap is 10%, then you're only going to get 10%. You're not going to get the 15. And that could suck for some people, be like, oh, I wanted to get all of it. The best way that I explain it to people, because this is also with an IUL, which is Index Universal Life, that's where you hear it most often, or in mutual funds, because there are index mutual funds. But if you think of it this way, if you're investing in the stock market and tied to the stock market, Mama, let's say both you and I you have an index and I'm in the variable. So you're tied to, I'm invested directly in, right? Our money is invested into the S&P 500, which is the most common one for the United States. The market goes up 15%. You have a cap rate of 10%, right? So let's say it goes up 15%. Both you and I'll say 10. Say it goes up 10%. Both you and I get 10%. We're doing great, right? The market decides to drop 5%. You don't lose anything, but I'm down 5%. So I'm at 5. And then let's say the market goes up another 10%. So your 10% that you already had plus another 10%, you're up almost at 20. I had to play catch up, so now I'm at 15. That's the best way I explain it. With an index, when the market drops, you don't have to play catch up when it decides to come back up. So if that is a holdup for you, you can think about it that way. And I mentioned performance rates. A performance rate is different than a cap rate. It is still a limit on how much you can make. It just depends. So a performance rate is a percentage of how much the money is going to be how much it's participating in that market. So if the participation rate is 50% and the market goes up 10%, then that means it's only participating in 50% of whatever that increase is. So 5% in that case. If the participation rate is 70%, then you got 7% of that 10. If it's 100%, then you get all of it. Whoever you are working with when you are looking for your fixed indexed annuity, make sure that they're showing you whatever market the money is going to be tied to, and they show you the participation rates and the cap rates so you know where your money is going. And make sure you definitely get, when it comes to a variable annuity, make sure whoever it is has their securities license, because legally they can't practice that, can't sell variable anything that is directly tied into the stock markets without a securities license. And make sure they're explaining everything to you. If you're with somebody and you're asking questions and they don't answer you, you need a new broker, because this is your money and you need to know where it's going, especially when it comes to your retirement options, because you don't want to be 65, ready to retire, and whoever you got your annuity through did not do a very good job and you've lost money. So make sure you're paying attention to that. What was the last thing? Oh, taxes when it comes to your annuities. The taxes on your annuities is going to depend on how you fund it. There are qualified annuities and there are non-qualified annuities. Your qualified annuities, those were funded with qualified retirement accounts such as a 401k, a traditional IRA, or a simple IRA. You just essentially rolled over that money from those retirement accounts into an annuity. And this is also why I said talk to your plan administrators, because those give you the rules on when you can roll over, if you can roll over, and how much. So make sure you talk to them about that. But those qualified annuities are funded with those qualified retirement accounts. And if that's the case, then the tax rules are going to be based on whatever the tax rules are for that account. So if it was funded with $400,000 from your 401k, whatever the rules for you, whatever the tax rules are for your 401k will be the tax rules for your annuity. If it is a non-qualified annuity, then your tax rules are a lot better. It's a little bit more free and there's a bit more tax advantages to that one. And basically, non-qualified annuities are funded similar to like a Roth IRA. They're funded with after-tax money. That money is already taxed before it goes in there. So when you receive your distributions, they are tax-free to a point. Your principal is not taxed. Any money that you put in there is not taxed. So let's say, for instance, you put $400,000 of after-tax money into an annuity, and it's time for that distribution. You will be taxed on any of the interest and the gains that come from that annuity. So your $400,000 isn't taxed, but everything after that will be. So there are taxes. It's just only on the interest and the gains, but not on your principal or what was initially in there, the $400,000. Yeah, there's a lot when it comes to annuities. There are different payment options, different premium options, different distribution options. There's a lot of different kinds of things. But that's the gist of your retirement options. Some main ones. You have your annuities, you have your retirement accounts, and you have your savings. I think it's best to have all three. The best thing you can do for your money is diversify. You don't want to put all your money into one basket, because if something happens to one basket, then all your money is gone. So diversify, put your money into different things. And remember, if it's a savings account, we're going to get a what? We're going to get a what kind of savings account?
Yields.
And we're going to look for anything above 4%. We're not doing those 0.0025%.
And
So we're
but
going to,
I do want to talk about that though, because if you do have, because most banks, when you open a checking account, they do require that you have a savings account as well. Now, this account is not useless. Like we can use that.
oh, it is definitely
We can use that
useful.
for short-term things. So that can be your what's called a sinking fund. So a sinking fund is for things that you know you have to do every single year, like you have to get registration for your vehicle every single year. So you can use that account for that, because with the high yield savings account, you have to maintain a minimum balance in that, right? So we don't want to use a high yield savings account for things that, for like emergencies or things that
Oh yeah,
that we
no.
know we have to do every single year. So
These are for a long
right.
term
So
options.
just be mindful of that. Yes, we know that the bank is going to give you that savings account that has the point zero something percent. It's good to have that, because you, like I said, you do need it for things that come up yearly.
Yeah.
Yeah. So and
Good
you
for
know,
short term, not for your long term.
right. So you're gonna need tires for your car. You're gonna need an oil change. So those are the kind of things you can use for the savings account that you get with your regular checking account. So don't say, oh my God, don't panic and freak out and say, well, I need to change this. No, use that savings account that comes with your checking account. Use that for the the short-term emergencies, or your sinking fund, things that come up that you only have to do once a year or twice a year or something like that. So
Yeah.
yes.
Don't throw out everything you currently have. If you already have some savings
No.
options that are working for you,
Yes,
don't dump them out. We're just giving you other options
absolutely.
specifically for long term things. Everything that I mentioned is long term. We in for the long haul type stuff. If you have short term savings options, do not throw them out. Continue to
Right,
do them. But
right.
I'm talking long term.
Absolutely. This has been great, Ari.
Yes, it has. We got through some good stuff. If
Yeah.
we are saving, we are looking at what we're spending, where it's going, and
Because your money has to do what? Be on assignment. It
it
has
has to
to,
be on the assignment.
your money is a soldier. Remember that. Your money is a soldier. You get to tell it what to do. Don't let it tell you what to do.
Right, and
Okay.
we gonna put some of that money aside so that when it's time for us to retire, we have money coming in and not as much going out, so we can relax.
Absolutely. Absolutely. And
You-
and I know I'm about to divert, because we got about 2 minutes. But I want to say this. Being the age that I am now,
You gave out my age, let's give out yours.
being this age that I am now, I am thinking about, yes, I'm 46. Being this age, it has never been more at the front of my mind that one day I may be in a position where I cannot care for myself, or even I just may not want to work. I may just want to sit and put my feet up and look at my grandbabies, or I may just want to look at the walls, right?
I'm
Um,
26 and I just want to do that. So yeah, I can imagine being older.
but the reality is, you know, it's some of the things that, when you learn better, you do better. Some of the things that we're talking about right now, um, I had the information in my head, but I didn't execute on it. So it's and I want to say this to somebody who may be in my age bracket, age range. It's not too late. It's not too late to start saving. It's not too late to put money aside, because this insurance broker that I know, she said you have to plan to live. Like, putting money aside is planning to live. When you get these IRAs, these annuities, that is you preparing to live. Because one of the things that I think is so selfish, and it's, I know ignorance is, I mean, people just don't know is one of the main reasons, but I think it is so selfish for a person to have children live their life and just, not plan for their future. And then in the event that they cannot care for themselves, or when they pass, because not if you transition, we all leaving up out of here. We can't stay in this dirt suit forever. I think it is so selfish to not have things in place so the people you leave behind won't have this won't have the stress of trying to fund your final expenses, right? So we have to start thinking about that. We have to start thinking about that right now. And I'm just thinking about the people that I have um known just this year alone, in 2025 alone, that have passed, that have passed away. Some prepared, some did not. A lot did not. They did not have monies aside to care for their children or for their family or even for their final expenses. And like we have to get serious about this. Stop. We can stop eating out once a week. Just put that money aside. So, okay, I'm gonna get off my soapbox.
Yeah,
'Cause
she
that
talked
is real.
about it
Because
does it's very important. And speaking to the people
yeah,
of my demographic and my age range, start now. Start now.
absolutely. If you're in
Start
your
now because the
20s,
sooner you start, the better. It's so much better.
right?
It's the sooner you start, the better.
Yeah, yeah.
So
So,
yeah, we will
okay, I'm back. I'm back. Sorry, I went
we'll
somewhere.
come back at y'all next week with some more information. But this week, we just focus, start figuring out what your spending plan is and
Mhm.
your savings plan is and your retirement options. And
Right.
if you are in the Memphis metro area and you are looking for your new home, please do not hesitate to contact my mother. All of her information will be in the description box and in the end card. And if you are in Tennessee, Maryland, or in New Jersey and you are ready to start planning for your retirement, or if you also need some life insurance, not if, when you're ready to start getting your life
And
insurance, please contact me. My information will also be in the description and in the end card. And we'll see y'all next week. Same time, same place. You ready?
wait, hold on. Wait, I gotta say this. You said so. First of all, I am licensed in the state of Tennessee and the state of Mississippi. However,
However,
because of the wonderful network that I'm a part of, I can assist you in any of these 50 states with
that's
real estate.
true. Got
So,
hands
so
reaching everywhere.
yes. Okay, that's all. That I just want to make sure this plug. Like,
He said everywhere.
don't limit me to Memphis. I'm
I,
licensed. I'm licensed in 2 states, but I can assist all over
well, my bad. In those two
the,
states.
the
But if
greater
you need help in
any state,
Iowa,
in
if you
any
need help in
state. I
Iowa, I'm
got
pretty sure
you.
she knows somebody in Iowa. Same
Yeah,
here. I know somebody in every 50 state when it comes to life insurance too
yeah.
within my own business
I told
network,
you I had a client relocate to Montana.
which was so strange to me. But
Montana.
anyway,
Anyway, y'all have a phenomenal day. We'll
yes,
see
have a
you.
phenomenal
Real
week.
life. Go
Have a
live your
good
real
one.
life.
Yes, especially in this new year. Y'all have a good one, okay? We'll see y'all. Bye. Thank y'all for so much for tuning in. What money saving techniques do you have? Do you think these are viable options for you? Getting money, setting it aside, and making sure you cannot see it, because we all know if it's right there, we can easily touch it, right? And what about your retirement options? Have you considered your retirement? Are you almost at the age of retirement? We highly recommend you start thinking about that now rather sooner than later. And of course, you can always connect with us, connect with my mom for all things real estate at Shanita Johnson on Instagram, Facebook, and on YouTube. And you can contact me for all things life insurance on Instagram, ari.j.john, TikTok, ari.j.john, and on YouTube, Future Planning with Ari. You can send us emails with the subject The Real Life to my mother at shanita@shanitajohnson.com. That's SHANITA. And then email me at arionjjohnson@gmail.com. That is ARIYANJ Johnson. Thank you guys so much for tuning in, and we will see you guys next week.